Hedge funds, institutions, quants, individual traders, all afraid of the weekend. Here's why you don't need to be afraid of that at all. Institutions and people managing big money don't necessarily want to get railed by some bad news that occurs over the weekend, which they have no control over what they can do with their positions. So they can take some of that risk off the table on Friday afternoon. Buying Friday, selling first thing Monday, that's it. 81% of the tickers are green, with a median return of just over 50%. Obviously, that's not as good as the 3x we've seen over the last decade in the S&P 500, but the point is this weekend effect isn't as scary as institutions, hedge funds, and others make it out to be. If you have just bought Nvidia on Friday, sold Monday, taking on all the potential downside risk possible, you'd still be up 16x your money. That's the best we've seen of any stock over that time frame. There are some fair share of absolutely horrendous losses, but again, the gainers make up for that in much more. Again, you can see we don't even get to a negative return until ticker 400. The top sectors, obviously the top, you guessed it, technology. And if there's any sign on this planet to have some exposure to long-term positions in the best mega cap companies that exist, it's probably this chart right here. Easily the best average return are those of the mega caps. Oddly enough, some months look to have some more dicey weekends than others, namely April, September, and December. But generally speaking, the weekends are nothing to be afraid of. So